For the week of 10th November 2025 to 14th November 2025, let us start with a quick executive strip view of the ES market, using the chart that you see for this weekly executive strip section as our visual anchor. Overall, my bias for this week is mildly bearish, not in the sense of an aggressive collapse, but in the sense that rallies are more likely to struggle and the market has work to do before buyers can fully regain control. The reason is that we do not yet see decisive follow-through from bear bars, and price is still moving within a tight bull channel on the daily chart, so the bears have the initiative but the bulls are still very much present in defending their ground. Against that backdrop, I want to focus your attention on the main operating range for this week, which is between 65.22 to 68.44. This band contains all of Zone 1, all of Zone 2, and everything in between, and it gives us a clear map for where price is most likely to trade and where we should be especially alert to shifts in control between buyers and sellers. Within this band, the key levels are very clear. Above, we have hard resistance in Zone 1, between 6800 to 6844, which is also where the daily moving average around 6800 sits as a magnet and potential ceiling. Below, we have soft support near the upper boundary of Zone 2 around 6655.5, which is where buyers have a reason to step in and defend, and we have hard support closer to the lower boundary of Zone 2 around 6525, where the market has already proven that demand exists. These levels form the skeleton of the week. On the macro side, Thursday is the big scheduled day, with both the CPI release and the 30-year bond auction, and that combination can easily inject sudden bursts of volatility into whatever trading range the market is building earlier in the week. Now let us think about Monday specifically. Because of Friday's strong reversal, the probability of an upside gap is modestly elevated, and if that happens we will be watching carefully how price behaves relative to the daily moving average around 6800. If the gap opens right at or very close to that moving average, which lines up with the lower edge of hard resistance Zone 1, I want to avoid aggressive new longs because that kind of open often leads to sideways trading or a quick reversal as trapped late buyers are forced to exit. In that situation, it is better to stand aside, wait for price action to confirm which side is really in control, and only then commit. If instead we see a small gap up followed by a strong bull bar, then going long above that bull bar with a stop below the gap and a target into Zone 1 becomes reasonable, and managing the position with a trailing stop lets us lock in gains as the market moves in our favor. In a gap down scenario, I still expect buyers to appear below the open, but their strength is uncertain, and a gap down would tell us that Friday's reversal has not yet convinced the majority that a durable low is in place. In that case, shorting only makes sense if the gap is clearly significant and if, after roughly 6 bars from the open, we see obvious bearish continuation rather than a sharp reversal. If that kind of clear downside follow-through is missing, it is safer to prioritize looking for long setups rather than fighting a possible reversal. Finally, if Monday does evolve into a clear bearish trend day, then price should work down into Zone 2 fairly quickly, retesting last week's low within 1 or 2 days, and there is more than a 50% chance that support will be found lower inside Zone 2, potentially deep into that area. So in short, this week opens with a mildly bearish tilt inside the 65.22 to 68.44 range, with defined resistance above, layered support below, and a very eventful Thursday on the horizon, and with that high-level map in mind we can now zoom out and walk through the monthly outlook. Now let us take a step back and look at the monthly outlook, using the monthly chart you see in this section as our guide. On the monthly time frame, the trend is still classified as bearish for now, and the probability that the current monthly bar will end up closing as a bull bar is below 50% at this stage. That does not mean buyers cannot win later in the month, but it does remind us that they are swimming against the current rather than with it. Structurally, the market has just come out of a parabolic climax on the monthly chart, with 6 consecutive bull bars, which is already a sign of exhaustion. After that surge, we now have an inside bar that has a shorter upper tail, and that pattern fits well with the idea of a market that is moving from urgency into digestion, where both sides are reassessing value instead of simply chasing the last direction. Because there are still about 3 weeks left in the month, it is too early to make bold claims about exactly how this bar will close. However, when we put the current configuration next to historical examples that follow 6 consecutive monthly bull bars, the odds generally tilt toward sideways movement or a modest reversal rather than an uninterrupted continuation higher straight into year-end. That is why I expect the market to spend the next few weeks mostly traveling between Zone 2 and Zone 1, building out a trading range and repeatedly testing the recently broken upper trend line from above. That retest of the broken trend line could come as soon as next week, or it could wait until closer to Christmas, but the theme is the same. The market is likely to verify whether that former resistance can now act as support. If the price tests that upper trend line and holds above it, and if the market does not stage a decisive reversal back into the larger channel, then the higher time frame uptrend remains intact and buyers will still have a credible case for eventual new highs after this pause. On the other hand, if that upper trend line fails to hold and the market falls back below it with conviction, then we should anticipate a sharper pullback that goes beyond a simple dip. In that case, the price would be drawn toward the prior breakout zone and even toward the monthly moving average around 5,970, because those are natural magnets and reference points after a parabolic move. In terms of concrete levels, the obvious monthly resistance to watch is the open of the current month around 6,877.5. As long as price is struggling below that level, the probability that this month ends as a bull bar is low, and any rally back toward that open will be a test of how much energy buyers really have left. On the support side, the first important level is soft support around 65.25 at the lower boundary of Zone 2, where buyers have already shown an interest in defending the trend. Below that, we have hard support around 6,242, which is the prior breakout zone and therefore a logical place for longer-term buyers to step in if the pullback deepens. If selling really expands from there, the market could extend down to the monthly moving average near 59.70, but that is still just an outer boundary of the current scenario rather than the main expectation. Taken together, this monthly picture tells us that the backdrop for the coming weeks is one of a market in post-climax digestion, likely oscillating between Zone 2 and Zone 1 while it works off the excesses of 6 strong monthly bull bars. So the big takeaway here is that the monthly chart supports a bias towards sideways action with a bearish tilt, and that sets the stage for our weekly outlook, where we refine how this broader context is playing out on a more tactical time frame. With the monthly context in mind, let us now narrow our focus to the weekly outlook, guided by the weekly chart shown in this section. On the weekly time frame, the trend is best described as mildly bearish, but once again this is more about expectations for sideways consolidation and controlled pullbacks than about a dramatic collapse. We are coming off a sharp pullback week, yet the behavior at the edges of the channel tells us that buyers are still engaged. Price has been moving in a tight bull channel, and within that structure we have already seen 3 notable pushes. The latest weekly bar closed below its midpoint, which is a sign of selling pressure, but at the same time we saw strong buying responses at the lower boundary of that channel, reminding us that this is still a market with active buyers who are not ready to give up the trend without a fight. When we combine that with the daily action, where the final bar of last week was bullish, it supports the idea that bulls remain resilient even within this pullback phase. Looking forward, I expect the coming week to show mild sideways behavior with a tilt toward another bearish weekly close. If that happens, it will confirm that the pullback is not over, and it will strengthen the idea that the market wants to at least probe further into Zone 2 and test the lower boundary of that zone. A small bullish weekly bar is still possible, especially after the strong defense we saw near the channel low, but it would not automatically erase the risk of further downside. Even if we get a small bullish bar, the market can still work lower in subsequent weeks to explore deeper into Zone 2. The scenario that would really change the tone would be a strong bullish weekly bar that convincingly reverses the recent pullback, but right now the probability of such a decisive weekly bull bar is below 50%, so it is a lower probability outcome for the immediate week ahead. As long as we do not see that strong bull bar, the odds favor either more sideways movement or a continuation of the pullback, with the balance of probabilities tilted slightly in favor of the bears. For the bears, the primary near-term objective on this time frame is straightforward. They want to see price move down to test the weekly moving average around the bottom of zone 2. That moving average, roughly aligned with the lower boundary of zone 2 around 65.25, is a logical target because it is where medium-term buyers have a reason to defend and where previous pullbacks have often found support. For the bulls, the path to regaining control is slower but still plausible. What they need is time and accumulation, meaning a sequence of sideways bars that show consistent buying at support and shrinking selling pressure at resistance. If they can build that base, the odds gradually increase that they will be able to push price back toward the upper part of the range and eventually toward new all-time highs after this period of consolidation. In terms of levels to watch this week, the map mirrors what we already highlighted in the executive strip. Hard resistance is still at zone 1 between 6800 to 6844, where sellers are expected to defend aggressively and where rallies are likely to stall at least on the first attempt. Soft support sits at the upper boundary of zone 2 around 6655.5, where responsive buyers may appear on dips. Hard support lies near the lower boundary of zone 2 around 6525, which is where deeper tests are likely to attract stronger buying interest. This weekly configuration tells us that while the market is leaning slightly downward, it is doing so within a broader trading range between clear resistance and clear support, not in a free fall. So in summary, the weekly chart reinforces the story of a mild bearish bias inside a developing range, and with that in mind we can now zoom in further to the daily outlook to see how these dynamics are playing out from one session to the next. Let us now move into the daily outlook and connect the higher time frame narrative to the day-to-day price action, using the daily chart that appears in this section as our reference. On the daily time frame, the market is essentially moving sideways but with clear bearish momentum woven through that sideways structure. We recently saw price push down through the daily moving average, leaving a gap below it, which is a sign that sellers were able to seize control for a while and force price away from its mean. However, last Friday's session closed as a bull bar with a very long lower tail, which tells us that buyers stepped in aggressively on the dip and were able to push price up from its lows by the close of the day. That long tail is visual evidence of demand absorbing supply at lower prices. It is also important to note that earlier the market attempted a breakout above the high from October 27th, but that breakout ultimately failed, and a subsequent retest on November 4th also failed to hold. Taken together, those failed attempts to sustain trade above the prior high tell us that the market is not yet ready to establish a strong new leg up and that breakout buyers above that zone have not been rewarded so far. Looking ahead from here, the open gap below the daily moving average may well close, meaning price can drift or push back up to fill that space as the market tests whether the moving average will now act as resistance. Even if that gap fills, though, the odds of a successful and sustained breakout above zone 1, between 6800 to 6844, remain low for now given the overall configuration. In practical terms, that suggests that the best case for bulls in the near term is often a sideways outcome rather than an immediate and powerful advance to new highs. One way to think about the current structure is to view the large bear bar from October 10th as the core of a trading range. If we treat that bar as the range, then the recent bullish breakout above its high has already failed, and that failure significantly raises the probability of a retest of the low of that bar. Importantly, that low lines up closely with the bottom of zone 2, which is why the lower boundary of zone 2 around 6525 remains such a critical reference for both sides. Under this interpretation, selling pressure is still in control of the edges of the range, and failed breakouts above resistance naturally lead to tests of support. As a result, traders should be prepared for the market to probe lower into Zone 2, even if there are strong intraday rallies along the way. At the same time, the strong bull bar with a long lower tail from Friday serves as a reminder that buyers are still willing to defend significant dips, especially near prior support zones. That means that while the path of least resistance points toward more testing of lower levels, the journey is likely to be choppy and two-sided rather than a smooth straight line. For day traders and short-term swing traders, this environment argues for a flexible mindset, respecting the bearish tilt but also respecting the evidence that buyers are not completely absent. In terms of specific levels, our daily map aligns with the higher time frames: hard resistance at Zone 1 between 6800 to 6844, soft support at the upper boundary of Zone 2 around 6655.5, and hard support at the lower boundary of Zone 2 around 6525. The market can oscillate between these areas while the broader structure evolves. So to sum up, the daily chart shows a sideways market with bearish momentum, failed breakouts above prior highs, and a likely path that involves further tests of Zone 2, and with that backdrop in place we can now turn to the 5-minute reviews to see how these themes played out in last week's intraday price action, starting with Monday. Let us look back at last Monday on the 5-minute chart that you see in this section and review the key lessons in the context of Al Brooks' price action concepts. Coming into Monday, the plan from the prior weekly outlook was to take profits on longs into 6,900 on a gap up and then wait for fresh signals, and the market delivered a very different message right from the open. Instead of rewarding continuation longs, it produced a clear sign of bearish momentum. Shorting below bar 1 was a classic price action entry, because it took advantage of early selling pressure near the top of a trading range and aimed for a retest of the range low. In the Al Brooks framework, this kind of early short is often a reasonable attempt to catch the move back into the middle or lower half of the range once it becomes clear that bulls are failing to break out. In this case, the daily low never made it all the way down to Friday's low, so if that was the original swing target, exiting above bar 14 was a sensible decision that respected what the market was actually willing to give. For traders using measured moves, the structure after bars 9 and 10 created a clear second leg, and placing a limit order at 1 times the measured move gave a very precise exit at bar 13. That is a textbook example of how measured move projections can help quantify risk versus reward once a second push in the same direction becomes obvious. Later in the session, the character of the price action shifted. Entering long above bar 17 or bar 18 was reasonable, particularly because bar 18 closed above the moving average, which in the Al Brooks approach often signals that the market may be transitioning from a bear leg into a trading range or even the early stages of a bull leg. The idea on those longs was to look for at least one leg up and possibly a measured move. The ideal exit on that long side trade came at 1 times the measured move, which was triggered very neatly at bar 52. That is again consistent with the principle that in a market that has already shown a strong bear leg, traders should be quicker to take profits on counter-trend longs as the trade reaches predefined objectives. Even for traders who did not calculate that measured move precisely, many positions likely ended up closing near break-even or with small gains by the end of the session as the market moved back toward a more balanced state. From an Al Brooks perspective, Monday was a good example of how an opening reversal at the edge of a trading range can lead to a strong first leg down, followed by a complex corrective structure that offers both measured move opportunities for the bears and counter-trend scalps or swings for the bulls. The key takeaway from Monday is that the market clearly rejected the previous plan of continuation above 6,900 and instead set a more bearish tone for the week, and that tone provides the context for how we interpret the gap in price action that unfolded on Tuesday. Turning to last Tuesday on the 5-minute chart for this section, we can see how the bearish tone from Monday carried over and how it interacted with classic Al Brooks ideas about gaps, trends, and measured moves. The day opened with a significant gap down that pushed price well below Monday's low, clearly signaling that higher time frames were still leaning bearish. From a price action perspective, a big gap down often means that the market is trying to form either a trend from the open or a trading range day that begins with a strong move. Shorting below bar 1 was therefore a logical trade idea, because traders were attempting to join what looked like a strong bear trend continuation. With a proper stop in place, that short was stopped out quickly at bar 3 as the market snapped back. This is exactly the sort of small loss that is acceptable and expected in trend trading, because in the Al Brooks framework you do not cling to bias when the price action says otherwise. Instead of fighting the reversal, the focus shifts to the new information the market is providing. Bar 3 printed as a strong bull bar that pushed above the high of bar 1, and that made going long above bar 3 a sound decision. That long trade treated the gap down as an overreaction that was being reversed, and it targeted 1 times a measured move, which offered a clean exit at bar 15. Given the overall bearish context and the location relative to prior support that had turned into resistance, aiming for twice the measured move would have been unrealistic. In the Al Brooks method, when the higher time frame is bearish and you are trading a counter-trend move, you generally scale back your expectations, because the odds of achieving an extended measured move against the dominant trend are relatively low. After longs took profits around the 1 times measured move target, bars 15, 16, and 17 formed a clear cluster that pointed to renewed downside probability. The price action there signaled that the bulls were losing momentum and that the bears were reasserting control near resistance. Shorting below any of those bars with a target to retest the open was a solid plan that aligned with the idea of a resuming bear leg inside a larger downswing. Managing that short with a trailing stop allowed the trade to run as the day unfolded, revealing a developing double bottom type structure. Later, converting the trailing stop into a fixed limit order around bar 63 captured the full 1 times measured move on the short side. This flexible management, combining initial trailing stops with well-placed limit exits, is very much in line with Al Brooks' guidance for trading within a strong but not perfectly smooth trend. The big lesson from Tuesday is that even on a strongly bearish day, the market can present both failed trend attempts and sharp reversals, and that being willing to switch from a losing short to a well-justified long, and then back to a short when the context shifts again, is critical. Tuesday reinforces the importance of respecting the larger bearish environment while still reading each new bar objectively, and that sets us up nicely to examine how the story continued on Wednesday. Now let us review last Wednesday on the 5-minute chart shown in this section and see how the market behaved after Tuesday's decisive moves. Unlike Tuesday's big gap down, Wednesday did not open with a dramatic gap, and that lack of a strong initial push meant there was no clear consensus at the start of the day. The first 3 bars moved sideways, which in the Al Brooks framework often points to a trading range open or a day that is still choosing between a trend from the open and a more two-sided structure. Then bar 4 closed as a decisive bull bar, and in this context that bar was an important piece of information. It suggested that bulls were trying to regain strength and push price back up to retest the prior trading range low from earlier in the week, which had now turned into a resistance zone. Entering long above bar 4 made sense, because it was an attempt to ride a potential trend up from the open or at least capture one strong leg up in what could become a trading range day. Using a trailing stop on that long allowed traders to stay with the move for as long as the market continued to produce higher lows and higher highs. However, when we look at how the rest of the day unfolded, we see that applying Tuesday's more aggressive profit-taking tactics would have produced only a modest gain on Wednesday, because the 1 times measured move target that traders might have hoped for on the upside never filled. Instead, the market spent a lot of time in sideways action, and the trailing stop was likely hit around bar 76, well before any large extension. From an Al Brooks point of view, that is a hallmark of a trading range type day, where strong-looking bars can quickly be followed by disappointingly small follow-through. Given the persistent sideways movement and the fact that price was confronting former support that had turned into resistance, a more conservative approach would have been to exit earlier, for example below bar 54, which would have locked in profits while the locus of control was still clearly with the bulls. Waiting for the trailing stop to be hit allowed the market to take back some of those gains, which is a good reminder that in a trading range, fading strength near resistance often performs better than always holding for perfect measured moves. In essence, Wednesday illustrated several classic Al Brooks themes: a lack of a decisive early gap, an apparent attempt by bulls to form a trend out from the open, and then a transition into a broader trading range where strong-looking bars did not lead to strong sustained moves. The key takeaway from Wednesday is that traders needed to adapt from the more trending behavior seen earlier in the week to a choppier, range-based environment, and that shift in character set the context for how Thursday's session unfolded. Let us move on to last Thursday on the 5-minute chart in this section and see how the market evolved after Wednesday's more balanced session. Wednesday had closed near its midpoint, which already hinted at an equilibrium between bulls and bears, and Thursday opened slightly lower with a modest gap. From an Al Brooks standpoint, that kind of open can easily lead either to a trading range day or to a trend day if one side quickly takes control. Shorting below bar 3 was a sound idea, because it aligned with the small gap down and targeted a retest of Wednesday's low. That short treated the open as the start of a possible trend from the open, with the expectation that sellers could push price down to test the prior day's support. If you took profits around bar 5, expecting the market to revert to trading range behavior, that was a reasonable first plan. However, the sequence of bars 12, 13, and 14 forced a reassessment, because the bearish momentum during that run clearly intensified. In hindsight, bar 13 stands out as the optimal short entry. It retested the prior trading range low and immediately met heavy selling, which in the Al Brooks framework is a classic sign that what used to be support has now turned into resistance and that bears are seizing control for another leg down. Waiting until bar 14 to enter would have been late, because much of the edge came from selling into that retest at bar 13 while the risk-reward balance was still favorable. Capturing the full bearish move on Thursday was not straightforward. The 1x measured move target based on the intraday structure remained unfilled during the regular session, which meant that traders who were strict about that objective may have had to sit through a lot of back and forth. Even so, the market retested the intraday low 3 separate times, offering multiple chances to evaluate whether the bears still had enough conviction to press lower. Each retest gave traders a decision point about whether to keep trailing stops tight, to scale out, or to take profits and wait for a clearer re-entry. A useful observation from Thursday is that holding a short overnight would have seen the 1x measured move fully completed at the open of the next trading day. That kind of hold is only appropriate when the higher time frame structure is clearly bearish and the probability of follow-through is high, which fits with the broader mildly bearish bias described in the weekly and daily outlooks. From an Al Brooks perspective, Thursday underscored the power of selling at retests of former support that has turned into resistance and the importance of recognizing when a modest gap and early weakness are evolving into a deeper trend rather than a simple scalp. The main takeaway from Thursday is that the bears were able to intensify pressure and extend the downswing beyond what earlier in the week might have seemed likely, and that momentum into the close gave important context for how Friday's session set up potential reversal opportunities. Finally, let us review last Friday on the 5-minute chart for this section and see how the week concluded in terms of intraday price action and Al Brooks principles. Friday opened with yet another gap down, and this time the downside momentum was clearly accelerating. That acceleration created an environment where aiming for a 2x measured move became realistic, and indeed the market reached that 2x measured move target very precisely at bar 30. What makes this level especially important is that it coincided with the lower boundary of the bull channel on the higher time frame, which is a significant structural support zone. In the Al Brooks approach, when a measured move target lines up with a major channel boundary, it is a strong signal to be very cautious about continuing to sell, because the probability of a major reversal or at least a deep pullback increases sharply. Continuous shorting into that area was therefore dangerous. Instead, once the market had completed that 2 times measured move and had touched the lower channel boundary, the focus shifted to signs that bears might be losing control. After the low, the price formed a higher low and then printed bar 41, which offered a high probability long setup for a potential major trend reversal. Going long above bar 41 was consistent with the idea that the market might be transitioning from a climactic sell-off into a reversal attempt, especially given the confluence of the 2 times measured move target and the channel support. Managing that long with a trailing stop allowed traders to stay with the developing move as the market worked its way higher. In this case, a patient trailing stop strategy could capture the full upside move into the close of the session, turning what had started as a dramatic bear day into a strong reversal day by the end. From an Al Brooks perspective, Friday is a textbook example of how a consecutive series of bear days and downside gaps can culminate in a selling climax at a major support level, followed by a higher low and a powerful reversal. For traders, the key is to recognize when the risk-reward for new shorts has shifted from favorable to dangerous and to be prepared to switch roles from selling rallies to buying credible reversal setups. The main takeaway from Friday is that the week's bearish momentum reached an important climactic point at the lower bull channel boundary, and the higher low long above bar 41 signaled that the market was ready to rally, a move that will be central to how we frame the coming week's outlook in our next update.